Good morning, good afternoon, and good evening, everybody. This is Jonathan and Dustin reporting back from Convoy. We wanted to fill in our what's probably going to be our last video before Mike comes back to do interviews with us, and we wanted to kind of give you guys an update on what's been going on in the market, but also just kind of different updates that have been happening across the board. So we'll just jump right in, and Dustin, if you want to take over the first one, we can go ahead and go that.
Yeah, so there's obviously been a lot happening in not just the mortgage market and mortgage rates, but the industry and the economy as a whole. I think we're seeing, obviously, now what the Fed's plans are going to be moving forward. The biggest thing driving mortgage rates, I would say, are three things, right? It's inflation, the economy, and the Feds. And inflation and an economy is what's driving the Feds to move. The problem is that the Feds can't find the right balance, because technically raising rates should help lower inflation and weaken the economy, but the economy is, showing some strong employment numbers and consumer spending's up. So now, if we're going to continue to battle mortgage rates, it's going to be with what the Feds do and how strong they're going to, move rates to battle inflation. But that's a never-ending cycle that, about a month ago or month and a half ago, everybody thought we were towards lower rates again and a lower rate environment. Well, that's quickly flipped, and you can see once we go over rates, or John will shortly, where rates have kind of moved and the adjustments that we're seeing right now.
Yeah, so to kind of piggyback off that as well, we are back. If you guys want to kind of put it into perspective, we're back to where we were in like September in terms of rates wise. So obviously we're not like October, November when rates were at the highest point it's been since for like a decade, but we're back to September levels. So you can pretty much expect that everything is kind of moved up significantly. So anything you've had done or priced out or quoted in the last 3 weeks is probably no longer valid, because the market's moved so much in those last 3 weeks. Now, in regards to rates itself in general, I mean, especially on the conventional side, there's articles now coming out from Yahoo Finance and everyone that we love that are now painting pictures of rates are surging to 7% and over 7%, and that's kind of where we're living in now, right? We're living in the over 7 range again, high 6s, mid 6s, and that's something we just need to be accustomed to. We had a little bit of a break and a breather, but now we're back up there. And one thing we wanted to add on is that on top of that, just overall higher rate environment, Fannie Mae and Freddie Mac, they rolled out new adjustments that are being added on to conventional loans, making pricing a little worse for anyone that has a debt-to-income ratio over 40% and a loan-to-value over 60%. So now you're going to see those things kind of kick in mid-March, early March. It depends on which lender it is, but they're rolling it out in phases. You're going to see it start to kick in and really affect the loan and debt-to-income ratio that you can qualify for, because these loan level pricing adjustments, if you go back to our previous videos, you'll understand what those are. But in a nutshell, they're just adjustments that are built into the rate that you receive. So now those are going to start coming into effect, and what that means for you is, let's say, for example, you have a 43% debt-to-income ratio and your loan-to-value on the purchase is over 60%. That means if you wasn't those cases, it would be maybe like 6.8. Now you're looking at 6.9. So it's going to be built into the rate sheet as well, as a loan level price adjustment to increase the rate. So that's another thing to tack on, a little extra whammy on top of the market being really in a tough spot. So that's the update there. And Dustin, if you want to fill them in on what new with the FHA.
Yeah, so kind of counter, the FHA actually reduced, sure, a lot of articles have been seen, but the private mortgage insurance that's normally added on top of your interest rate when you pay on an FHA loan, it previously used to be 0.85. They reduced it to 0.5, right? Yeah. In some cases lower if you're doing like a 15-year fix, but that was one of the positives. I think the FHA probably saw an opportune time to kind of make the spread in terms of the payment and the rate a little bit narrower between conventional and FHA pricing. So, if you're buying your first home, if you're buying a primary residence, you should see some or less of a spread between what you could qualify for payment-wise on an FHA loan now versus a conventional than, literally 2 days ago.
Yeah, and this is huge for a lot of, again, like Dustin said, first-time home buyers. So if you definitely have something priced out as a conventional and that was like maybe 2 weeks ago and you're doing like a 5 to 10% down payment, we suggest, hey, give us a call or give someone else a call in regards to looking into FHA options as well, because it's going to not be that different anymore. The last thing we wanted to really touch base on in terms of an update wise is the new Fannie Mae and Freddie Mac rule of cash out seasoning. So for all of you viewers in Texas, you are already familiar with this. With any homestead and primary residence, you're limited to one cash out per year, right? And now Fannie Mae and Freddie Mac have adopted that rule. So if you're doing a conventional cash out, just know that if you've done a loan in the last 12 months on a cash out, you have to wait another 12 months in order to do another cash out from the note to a note date. Okay, so now what that does is it really limits the amount of extra equity that people can pull out in the form of cash through conventional loans. Where we kind of are able to assist, and a lot of other non-QM lenders are able to assist, is non-QM doesn't have that rule of a 1-year cash out seasoning. So now, since there is that limitation of higher rates on conventional, and on top of that, you're getting hit with another cash out restriction, we are able to kind of help our clients still get the cash out, take the equity out, do their investing, continue to build their portfolio even when the market's like this, because we believe there's a lot of opportunity. So 12 months cash out seasoning from note to note is now into effect for conventional loans only, which means that, again, if you just cashed out, you won't be able to cash out for another 12 months. The way that we can overcome that is to go non-QM and to go to a different program that's pretty much the same as conventional now, but to allow you guys to cash out and really take advantage of the equity that you have built into the property. So, Dustin, anything else you want to add on that?
No, I think these are, all things that everybody that's watching this needs to consider, and just staying on top of where the lending market is right now. So hopefully you guys enjoyed that.
Yeah, and if you have any questions whatsoever, go to convoyhomeloans.com and let us know you came from ORAD, and we'd be more than happy to help you guys out. So thank you so much for your time. Have a great day. Stay warm wherever you are, and talk to you soon.
Thanks.